natural person. So shareholders are those persons who have provided capital to the company. Shareholders are those persons who have provided capital to the company. So when the company provides a return, for example, this is a company, this is a company, PLC for UK, right? PLC for UK, SAR for GmbH for Germany, limited company for India, and then there are SA and SARL, I think, for France. Several, suffixes. So when you find that this is a company which is legally incorporated, you have shareholders, as I mentioned. So shareholders contribute capital. So these are shareholders, and shareholders they contribute capital. They have contributed capital, money, more often than not money. They provided capital, and this capital is equity capital. So when the company makes profit, then the company would distribute the profits among the shareholders. So this distribution of profit that the company makes to the shareholders, that return on this capital, this is dividend. Fine. So from the perspective of the shareholders, it is the dividend distribution by the company is sort of a return, is an income on the capital that they have provided to the company. Right? So this is the very, very general, but yes, this is the concept behind the word dividend. That dividend, shareholders provide capital to the company, and company provides a return on that capital. Company provides a return on that capital, and that return on capital, that income on capital, is the dividends. Right? So the very, very basic concept of dividend, this is the concept. Right? So with this general concept of dividend, let us move over to 10.1. And again, as I have mentioned on several occasions before, that articles 6 to 21, distributive articles, taxes on income, they contain three categories of income. First one, that category of income over which exclusive right of taxation is given to the source state. 7.1, 12.1, the use of word shall. Second category of income where the right of taxation is not exclusive, and where the right of taxation is given to the source state, but then the source state can tax without any limit. There is no limit on the tax rate which source state can impose upon that stream of income. And the use of the word is may. So because the use of the word is may and the right to taxation is not an exclusive right to taxation, it means resident state can also tax. Similarly, the third category of income is that income wherein the source state is again given a right to tax, but then there is a limit which is imposed on the maximum rate of tax which can be imposed by the state of source, estate. And again, because the right of taxation is not an exclusive right, that is why the resident state can also tax, may also tax. Obviously, we know by the general principle, and I mentioned it very, very clearly when we were discussing jurisdiction to tax, and then tax methods for providing tax, methods for providing relief for double taxation, that when a state is taxing and when our state is taxing, it becomes the responsibility, it becomes the obligation, it becomes the onus on our state to provide double taxation relief. Fine. So consider that this article 10, this article 10 is also that article that provides that that right to taxation with the source state as well as with to the resident state. In this case also, the right to taxation is not an exclusive right. Right? There is one exception, we'll take care of that, but then the right to taxation provided, as we'll discuss in different clauses, right to taxation in article 10 is not an exclusive right, as was the case in 7.1. Fine. So you find that the right to taxation can be, there is tax sharing between our state, between the estate. Fine. So 10.1, okay, 10.1, the very, very first clause, 10.1, the first clause, and we'll have a lot of diagrams in this article. Fine. Okay, so see, 10.1, I'll give you very, very, this is A and this is B, this is A and B, and you can go on drawing these diagrams. Fine. This is A and B. A and B are two treaty states, they are two contracting states, they have a tax treaty between them, and you can assume the tax treaty is based upon OECD Model Tax Convention 2017. Fine. So they have a company, for example, this is a parent company, Parco, and this is subsidiary subco. Parent company Parco, subsidiary company subco. Fine. Okay, and the subco, obviously this would a co-parent company would be holding certain amount of percentage shares, percentage capital in subco, in this subsidiary company, and at the end of the year B, this subco, which is resident in state B, Parco is resident in state A and subco is resident in state B, tax resident. Fine. So at the end of the year, this subco distributes dividends. So this would distribute dividends. See, these are dividends from subco to Parco as a return of the equity, as a return on the equity which Parco has invested in subco. So this is dividend. So 10.1 would say that these dividends which is the resident company of state B is providing to the is paying rather, with these dividends which the resident company of state B, that is subco, is paying to the resident company of state A or to the person of state A, we'll assume the company, these may be taxed in state A. So it starts with the right to tax being awarded to the resident state. Right? So it says 10.1 would say that these dividends may be taxed in the R state. Which is the state of Parco, that is state A. Fine. So this is the substance of your article 10.1. Fine. Very, very simple. Now, as I told you that there are nuances, we'll take care of those nuances when we'll go to the further discussion as well as to the commentary. But this is in just what is being given by 10.1. Okay. Fine. 10.2 would say, and remember, as I mentioned, I am again repeating that the use of the word when 10.1 is saying that these dividends which subco is paying to a person of state A, a person resident of state A, which in this case is Parco, these may, the use of the word is may. These may be taxed in state A. May be taxed. Fine. When you come to 10.2 would say that these dividends may also be taxed in state of source, that is in state B. Fine. So 10.2 says that the dividends may also be taxed in S state, that is state B. Source state may also be taxed. May also be taxed in source in the source state, that is state B. But then 10.2 moves ahead. 10.2 moves ahead and then places certain limitations on this taxing right. It says that however if the person to whom the dividends are being paid by subco, that is in this case Parco, it says 10.2 says that if Parco is the beneficial owner, if Parco, 10.2 says that if Parco is the beneficial owner, and I will use BO. If Parco is the beneficial owner of these dividends, if Parco is the beneficial owner of these dividends, then the maximum rate of taxation that state B can impose on these dividends is 5%. Fine. So therefore, in this case, the maximum tax rate would be equal to 5%. Maximum tax rate would be equal to 5%. Fine. So this is the limit. This is the limit which is imposed by 10.2. Fine. Okay. Then 10.2 further moves. It says that in other cases, for example, if this is not a legal company, if this is a natural person, then this limit of taxation is raised to 15%. In all other cases, when there is a company, the maximum rate of taxation is limited to 5% capping. But then in all other cases, it would say then the okay. In all other cases, maximum tax rate would be what? Limited to 15%. Limited to 15%. Fine. So this is what is mentioned in 10.2. Obviously, we'll have to dwell upon the concept of beneficial ownership, but as I mentioned, I'm simply giving you the overview, the gist of the articles. Fine. So this is your 10.2. 10.1, remember, 10.1 awarded the right of taxation to the resident state, our state. 10.2 has awarded the right of taxation to a state, that is state B, our state. Our state is A and a state is B. Fine. And in addition to awarding the right of taxation to a state, the capping has been imposed by 10.2, which in the case of companies is 5%. And that too, if the company which is receiving, if the company to which SUBCO is paying the dividends, this company is the beneficial owner of these dividends. If this company is the beneficial owner of these dividends, and in all other cases, the maximum rate of taxation is 15%. Fine. Now, before we move to 10.3, there is one more condition which is placed by 10.2 for the maximum rate of taxation which is limited to companies at the rate of 5%. In this case, one of the condition is that they should be the beneficial owner. And then the second condition which is imposed by 10.2 is 10.2 says that in addition to being the beneficial owner, this company Perco should have held a minimum of 25% of the capital. Minimum of 25% of the capital of SUBCO. This Perco should have held a minimum of 25% of the capital of SUBCO throughout a 365-day period. So minimum capital requirement of 25% has to be maintained by Perco in respect of the equity ownership in SUBCO for the time duration, which is minimum 365 days. And this 365 days, mind you, this 365 days requirement, this 365 days, this also includes the day on which the dividends are distributed. That is the payment day of the dividends. So payment day of the dividend including, and before that 364 days. For this entire 365-day period, this Perco should have held a minimum percentage capital in SUBCO equal to 25%. And number 2, so this is the second condition, BO 25% ownership, and then third, that this holding should be direct, not indirect. So it should be directly held. So these are the three conditions actually. If these are satisfied, and these have to be satisfied in together simultaneously, then in this case the maximum rate of taxation which the source state can impose is limited to 5%. So this is the gist of, in all other cases it is limited to 15%. So this is the gist of 10.1 and 10.2. Sahil, is it clear?
Yes.
Fine. Switch off the mic. So this is 10.2. Now we move on. Yeah.
So basically 10.1 specifies the general rule that the resident state will tax
but 10.2 gives the exception that that the source state can tax as well, but the conditions are these.
You can say, because in this case now we are into the arena of tax sharing. So ultimately the right to taxation would be given to the R state as well as to the S state. But yes, because default rule is that resident state shall tax if even if it is an exclusive taxation. So yes, you can say that 10.1 starts with the right to tax being given to the resident state, and then 10.2 will give the right to taxation, right to tax to the source state. Obviously, it will place certain limitations. Fine.
I have a question here.
Yes, I do.
Basically, in OECD model, the 665 days criteria is mentioned, but in most of the treaties, the number of days is not mentioned, I think.
This is the model convention, no? That is why I said that tax treaty between A and B is based upon OECD Model Tax Convention. So for if it is 365 days or less or more, then accordingly you have to go to the treaty. Then you have to go to the treaty, and in that case you'll have to interpret what is the requirement that has to be met. Right?
Okay.
Fine. So this is 10.1, 10.2. Okay. Then we move on to 10.3. 10.3 will do what? 10.3 will give you, okay, this is fine. 10.3 actually gives you a sort of definition of the word dividend. Definition of the word dividend. And you know what? Definition of the word dividend actually, OECD very specifically mentions in the word in the commentaries that so many countries, especially, and it's talking about the member countries, that is member countries of OECD. The commentary is saying that a lot of effort have gone into creating a sort of definition that would include the various concept of various definitions of the member countries within that single definition. Meaning to say that it's saying that that there are substantial differences. That there are substantial differences in the way that member countries define the word dividend. So afterwards it says that in spite of effort of so many years, it has not been possible to create one definition of dividend that would include every form of dividend which is included in the domestic country. So that is why instead of giving a general definition, it is just giving you certain examples that what all is included in the word dividend. Right? And in this context, it includes three forms of payments which are included in almost all the countries, all the member countries. First, it says that income from shares, fine. Dividend includes income from shares definition. Okay, or I should say instances of dividends. Instances. Income from shares, fine. Second would say that income from rights which are not debt claims. Income from rights which are not debt claims, because if you would have a debt claim, then the income would not be dividend, it would be interest income. So income from debt claims, income from debt claims, and then the third category is income from other corporate rights. Right? So this is the sort of a definition clause which gives you, which although doesn't define the word dividend, but yes, it gives you a certain illustrations which can help you to classify what is included within the concept of dividends. Fine. And then when we'll go to the commentary, we will see that in certain instances, if certain conditions are satisfied, then even the income which is arising from loans, the income which is arising from so-called loans can also be categorized as dividends, and because it gets categorized as dividends, therefore it comes within the taxation net of Article 10. And what are those conditions? We'll see when we go to the commentary. But then this is just of 10.3. Fine. 10.4, Article 10.4 is the P article. Fine. It says, Article 10.4 says that state B and state A. Fine. And same, B pays dividends to, sorry, this is subco, this is parco. Well, let us not use pair and sub, simply use company ACO and BCO here. This is BCO and this is ACO. This is ACO and this is BCO. So BCO is paying dividends to ACO, and then ACO has a P in state B, and you find that these dividends are actually connected, effectively connected. These dividends are effectively connected with the PE. So 7.4 would say that if you find this sort of a condition, that company B, I mean, although see, this is 10.4 is very, very similar to 10.1. The only difference being that now in this case, the company of the other contracting state, that is state A, that is having a P in state B, and state B is the source state. And in this case, ACO is receiving the dividends which are paid by BCO, so no difference as far as this is concerned. But then you find that these dividends are effectively connected with P, and the P is in state B. So if this condition is satisfied, then 10.4 will take you to Article 7. It would say that in this case, Article 10 will not be applicable. You will have to go to Article 7. You will have to go to Article 7, 7.1.